Welcome to the Consumer Financial Protection Bureau's meeting of its Community Bank Advisory Council, or the CBAC. The Consumer Financial Protection Bureau is an independent federal agency whose mission is to help consumer finance markets work by making rules more effective and by consistently and fairly enforcing those rules, as well as empowering consumers to take more control over their economic lives. My name is Zixta Martinez. I serve as the Associate Director for the External Affairs Division at the Consumer Bureau. Today's meeting is being held at the Consumer Bureau's headquarters in Washington, D.C. This is the Advisory Council's first meeting of the year, and as always, we have a packed schedule. Today's meeting is being live streamed at consumerfinance.gov, and a recording will be made available on the same website. You can also follow CFPB on Facebook and Twitter. Let me spend just a few minutes telling you about what you can expect at today's meeting. First, I'll introduce the Bureau's CBAC members. Then, the Consumer Bureau's Acting Deputy Director, David Silberman, will provide opening remarks. Following the Acting Deputy Director's remarks, CBAC Chair David Reiling will conduct the meeting. Chair Reiling will introduce Sherry Wolf, Counsel in the Office of Regulations, and Brian Kreisworth, Deputy Fair Lending Director in the Office of Fair Lending and Equal Opportunity. The two will lead a discussion about the Bureau's recent request for information about alternative data. Following that discussion, the CBAC will hear from Will Wade Gary, the Assistant Director for the Card, Payment, and Deposit Markets team, and Stephen Chen, Managing Counsel for the Bureau's Office of Regulations. The two will lead a discussion about the Bureau's request for information about consumer access to financial records. The meeting will then adjourn at approximately 5 p.m. The Bureau established a Community Bank Advisory Council to include representatives of community banks from across the U.S. The CBAC is charged with providing substantive information, analysis, operational expertise, knowledge of their communities, and feedback to inform the Bureau's work. Today's public meeting and discussion is in support of this important responsibility. As a reminder, the views of the CBAC members are their views. They are welcome and greatly appreciated, yet they do not represent the views of the CFPB. So let's get started with an introduction of our CBAC members. The chair is David Reiling. David is CEO of Sunrise Banks in Minneapolis, Minnesota. The vice chair is Angela Belke. She is vice president, mortgage department manager of American Bank and Trust in Huron, South Dakota. Jonathan Allen is Chief Compliance Officer of Bank of American Fork in American Fork, Utah. Melissa Ballard is Vice President and Director of First Iowa State Bank in Albia, Iowa. Menzo Case is President and CEO of Generations Bank in Seneca Falls, New York. Kathleen Cook is President and CEO of the Village Bank in St. Library, Illinois. Linda Fieri is Vice President of CRA and Fair Lending Officer at Citywide Banks in Denver, Colorado. Jack Hopkins is President and CEO of Core Trust Bank in Sioux Falls, South Dakota. Brenda Hughes is Senior Vice President, Director of Mortgage and Retail Lending at First Federal Savings Bank of Twin Falls in Twin Falls, Idaho. Dion Kidd Johnson is President, COO, and CRO at Western Bank in Alamogordo, New Mexico. Ricardo Leal is Community Lender and Senior Vice President of First Community Bank in Harlingen, Texas. Cara Quick is Vice President for Compliance of First Hope Bank in Hope, New Jersey. Cal Radcliffe is Senior Vice President and Chief Compliance Officer at Bank of North Carolina in High Point, North Carolina. Trent Sorby is President of Central Payments Division at Central Bank of Kansas City in Kansas City, Missouri. Thomas Spitz is the Chief Executive Officer of Settlers Bank in Windsor, Wisconsin. And Samuel Vallandigham is President and CEO of the First State Bank in Bourbonsville, West Virginia. We also have with us Delicia Hand, Staff Director for the Bureau's Office of Advisory Board and Councils. I'm now pleased to introduce David Silberman. Prior to his current role serving as the CFPB's Acting Deputy Director and Associate Director for Research, Markets, and Regulations Division, David Silberman worked for 12 years as General Counsel and Executive Vice President of Kessler Financial Services. David began his career as a law clerk to U.S. Supreme Court Associate Justice Thurgood Marshall, and then as a member of the law firm Bredoff and Kaiser. David, you have the floor.
Thank you, Zixta. And on behalf of Director Cordray, who's unfortunately traveling today, I want to welcome you to this meeting of the Community Bank Advisory Council. We created this council almost 5 years ago because we wanted to ensure that we have a consistent way to hear directly from community banks about what they are seeing and hearing in their communities and about how our work is affecting their businesses. We do not supervise banks with $10 billion or less in assets, which means that we do not conduct examinations on any community banks. Yet we know that the regulations we write directly impact these institutions, as they are the first to let us know. The Advisory Council fills the gap in our day-to-day contact and helps to ensure that the lines of communications remain open at all times. We value the dialogue we have with our CBAC members, whose perspectives and the information they share influence our thinking. We talk to them about our policy-making agenda, and they consistently provide essential feedback that helps us understand the experience of their customers and how their institutions operate. All of that improves our work in many ways, and I hope demonstrates that here at the Consumer Bureau, we're eager to listen and deepen our understanding. Today, I want to highlight some of the work the Bureau is doing with respect to innovation in the consumer financial marketplace, and specifically our work involving the use of data in that marketplace. We will then engage the Council in a discussion of these issues. From early on, the Bureau has made it a priority to focus on the topic of financial innovation, which in today's world typically means technological innovation. I know and appreciate that such innovation can both be a challenge and an opportunity for our community banks, and so I'm particularly looking forward to today's discussion. One area of interest to us at the Consumer Bureau is the way in which data about consumers' financial transactions is being accessed and utilized in the financial marketplace. We see dramatic changes which hold the potential to improve the way consumers manage money and direct their financial affairs. Many of these innovations rely on access to to current information drawn from the assets, balances, and transactions in consumers' financial accounts. These include savings and checking accounts, and for those who have them, prepaid card accounts, credit card accounts, and investment accounts. In each case, the information recorded about the consumer can be a valuable asset in helping consumers budget or obtain credit. Indeed, it may matter as much as the dollars they actually have in their accounts at any given time. That is what appears to be driving efforts to access this information on consumers' behalf. These changes in the way information is accessed have not been without risk to consumers or to their financial institutions. So we want to understand how consumers and third parties are accessing and using such data and how it fuels new innovations. We also are deeply interested in how consumers are exercising control over their personal financial data, including the data that is maintained by their financial institutions. In November, we issued requests for information to inquire about the challenges consumers face in accessing, using, and securely sharing their financial records, and about the impacts on financial institutions when consumers access this data through third parties. We are working to assess whether barriers exist between consumers and the personal data that their financial providers maintain about them. And we want to hear solutions from stakeholders that can help address the risks and technological challenges pose when consumers seek ready access to this data and seek to share it electronically. We are keenly aware of the serious issues around privacy and security for consumers and financial institutions alike. One pressing issue is how to satisfy the demands of consumers without exposing the institutions that maintain this data to undue costs or risks. Another pressing issue is how to prevent consumers from subjecting themselves to undue risks, including the possibility that their data could be misused. Over the past few months, we've received about 70 comments from stakeholders across the spectrum. We are sifting through these comments, which are extensive and thoughtful. They present a wide range of ideas about how best to achieve the broad goals we have in mind. Certain perspectives presented in the comments are not surprising. Banks and other financial companies raised concerns about consumer data security and offer solutions that may address those concerns. Aggregators and users of the data, in contrast, are recommending less fettered access and greater freedom to store and use the data that consumers permit them to access. This would give them more flexibility, they say, to enhance their services and their business models. Almost everyone is offering arguments that their approach will better protect the interests of consumers. At stake for us is how consumers can control in a safe and secure manner what data is shared and how the data is used. So there's much to digest, and we see the market moving quickly with high stakes for all involved. Even as we speak, vigorous and spirited negotiations are underway throughout the industry that could shape the future of information access. We expect the interests of consumers to be at the forefront of these discussions. We are therefore concerned about reports we have heard that some institutions may be seeking to limit or restrict access unduly. In today's meeting, we are particularly interested in how community banks help their customers access their data and how they are impacted by data aggregators accessing data on behalf of their customers. This will be the subject of our second session this afternoon. I also want to provide an update on our latest actions to explore the use of new types of data in assessing the creditworthiness of consumers who are seeking credit. As you no doubt know, over a period of decades, large portions of the financial services industry have become dependent on automated underwriting systems to make their credit decisions. These systems, in turn, are dependent upon the data that is maintained by the 3 national credit reporting agencies and that fuels the credit scoring models with which we are all so familiar. This creates something of a catch-22. Consumers who lack a credit report and lack a credit score are largely shut out of the mainstream credit system, and as a result are deprived of the opportunity to build a credit history. Some have suggested that the thoughtful and responsible use of alternative data, that is, data that is not part of the traditional credit reporting system, could expand the credit available to underserved consumers. If it is possible to expand opportunity in this matter, it would benefit not only these consumers, but perhaps would buoy the economy in ways that benefit all of us. So in February, we launched an initiative to learn more about issues raised by alternative data, as well as by new methods of analyzing and using the data. In particular, we issued a request for information to obtain feedback from stakeholders about the potential benefits and risks of using unconventional sources of information and new modes of analysis to assess people's creditworthiness. We want to know whether various types of such data can help more consumers build their credit histories and gain more access to credit. Just how many consumers are we talking about here? Well, as a self-described data-driven agency, naturally the Consumer Bureau has dug into the data to gain a deeper understanding. After crunching the numbers, we estimate that 26 million Americans are credit invisible, meaning they have no credit history at all. Another 19 million people have credit histories that under most models are too limited or have been inactive for too long to generate a reliable credit score. So that means that 45 million Americans, roughly 1 in 5, fall into one of these categories. For every one of them, managing the ways and means of their lives usually costs more, risks more, takes longer, and does less to build their financial future than is true for most consumers. That is simply a tragedy in a modern economy and a modern financial system like ours, and we all need to think harder about what we can do to address it. Certain long-standing products, such as secured credit cards, can provide part of the answer, and we hope and encourage that those to be actively offered to these consumers. But we also want to explore ways to enable consumers who cannot afford to put down a security deposit to obtain responsible and affordable credit when they need it. And that is where alternative data holds promise. For example, alternative data may draw from sources such as rent or utility or telecommunications payments, which in general have not traditionally been part of the credit reporting system. It may draw from electronic or other records of transactions, such as deposits, withdrawals, or account transfers. And it may include other personal information, such as data generated from the use of mobile phones or internet services. The idea is that by filling in more details of a consumer's financial life, this information may paint a fuller and more accurate picture of their creditworthiness. So adding alternative data into the mix may make it possible to open up more affordable credit for millions of additional consumers. Through the request for information we issued last month, we are looking at the pros and cons of using the types of alternative data available today and what the future may hold as technologies continue to evolve. We are looking at how this information is gathered and analyzed so that we can better understand how all of this is beginning to unfold. Now, for many of our CBAC members, all of this may seem quite odd. After all, community banks have long prided themselves, and justifiably so, for their willingness and ability to go beyond the numbers, to understand their customers' life circumstance, and to make lending decisions based on the totality of the information available to them. In many ways, what we are exploring is whether there are opportunities to combine the rigor and objectivity of automated underwriting with community banks understanding that good underwriting requires more than simply looking at a 3-digit credit score. Some of the main inquiries we posed in our RFI are these. First, can the use of alternative data to create or augment individual credit scores actually increase access to credit for consumers by helping lenders better assess their creditworthiness? Second, will this lead to more complex lending decisions for both industry and consumers, and what risks would that pose? Third, how might the use of alternative data, new modes of analysis, and new technologies affect costs in making credit decisions? Finally, and quite significantly, how may the use of alternative data affect certain groups in ways that might run afoul of the fair lending laws or create other risks for vulnerable consumers? We are hearing from innovators who want to expand access to credit or offer credit at lower interest rates to borrowers whose credit scores may understate their ability and willingness to repay. And we see promise in some consumer-friendly innovations that bring new products to the unbanked and underbanked. These approaches also pose risks, and we want to know more about these risks and how they can be mitigated or minimized. On the whole, we are encouraged by the potential for using alternative data in underwriting to benefit the very consumers that the fair lending laws are designed to protect. So as we think hard about these issues, we welcome our members of our advisory council, to also provide feedback and be a part of the frank and wide-ranging discussion we have begun on this subject, so that we can learn from you and you can further inform our approach. We're eager to hear your experiences and perspectives today. Thank you.
Thank you, David, and thank you, Zixta. Welcome to the second meeting of 2017 of the CFPB's Community Bank Advisory Council. My name is David Reiling. I serve as chair to the CFPB's Community Bank Advisory Council. I'd like to welcome the members of the public as well as the members of our Community Bank Advisory Council. This council has served as a resource for both the Bureau and its participating institutions to engage in dialogue so that the Bureau can learn more about how community banks operate compared to their other peer financial institutions. During this afternoon's meeting, we will hear from council members on two issues: consumers' rights to access financial accounts, as well as account-related data, and the use of alternative data models for credit decisions. To get our session started, we will focus on the Bureau's recent request for information about the potential use of alternative data and modeling techniques in the credit process. Alternative data and modeling techniques are changing the way some institutions do business. For some, like community banks, it is how we have always done business. We meet our members where they are, and sometimes we need to take into consideration additional information. I'd like to now invite Albert Chang, Counsel, Office of Fair Lending, and Sherry Wolf, Counsel in the Bureau's Office of Regulations, to provide an overview of the recent request and engage us in confirmation. Albert and Sherry.
Thank you, Chair Reiling, for the opportunity to speak before the Advisory Council. Sherry and I are pleased to discuss the Bureau's work on alternative data, including the recently published request for information on the topic. I'll plan to kick it off with a summary of the motivations for the Bureau's work in this area. Then I'll turn it over to Sherry to then discuss the work of the Bureau's Alternative Data Working Group, of which we're both a part, as well as how the RFI itself is organized. We'll then both describe some of the perceived pros and cons, as described in the RFI, associated with alternative data use, at least as described in the RFI, and then we'll open it up for discussion by the Advisory Council on this topic. So going on to the next slide, in terms of motivations, as many of you probably already know, part of the Bureau's mission involves ensuring that consumers have access to financial products and services in a market that's fair, transparent, and competitive. That being said, access to traditional forms of credit for some time now has depended in part on whether or not someone has a credit score or some form of traditional credit history. And so, as the Deputy Director mentioned, one of the questions that the Bureau had a couple of years ago was just how many people potentially lack a credit score or a traditional credit history. And by the same token, just how many people might benefit from the consideration of alternative data or alternative information that might help demonstrate their creditworthiness. The CFPB's Office of Research performed an analysis, and what they found in a data point on credit invisibles that was published in early 2015 was that 26 million Americans have no traditional credit history on file with the major credit bureaus and therefore lack a traditional credit score. What they also found was that an additional 19 million Americans have some form of traditional credit history, but that history is either too thin or too old to generate a traditional credit score. And so in totality, 45 million Americans lack a traditional credit score, and as such, face additional hurdles in accessing traditional forms of credit. Moving on to the next slide, the Office of Research also looked into the composition of those folks who lack a credit score. And what they found was that folks without a credit score tend to be disproportionately young adults. They tend to be disproportionately those from lower income areas. They also tend to be disproportionately African American or Latino. Looking here at slide 4, which breaks things down by race and ethnicity, on the left panel, you can see that in terms of absolute numbers, the majority of folks without a credit score are in fact white. On the right panel, however, which looks at things in terms of the fraction of each group without a credit score, you can see that the fraction is in fact higher for African Americans and Latinos than it is for other groups. These charts also break things down by exactly why these folks lack a credit score. And so if you see in terms of the medium green shading that's at the bottom of each bar, which represents no credit history on file, you can see that regardless of group, most folks lack a credit score because they have no credit history on file. And that, of course, reflects the overall trend that we just mentioned, with over half of the 45 million lacking any credit history whatsoever. Now, you can imagine that other groups might also be disproportionately affected by this issue. So, for example, we mentioned young adults who are just getting started. You can also imagine that recent immigrants who might have a credit history from the countries from which they arrived, but not in the US, might be disproportionately affected. And you can also imagine that those who are recently widowed or divorced might also be disproportionately affected by this issue. Of course, regardless of who you are, not having a credit score or a traditional credit history means just another obstacle in accessing traditional lower cost forms of credit. And so to the extent that alternative data at least holds the promise of expanding access to responsible credit to at least some of these 45 million, by allowing some of these folks to demonstrate their creditworthiness through a different means, that has been one of the motivations for the Bureau's ongoing work with respect to alternative data. And to speak more about some of that work, I'll hand it over to Sherry Wall.
So the Bureau has, of course, excuse me. The Bureau has, of course, been interested in the use of various types of data and modeling techniques for quite some time. It's relevant to our work on multiple fronts. As you all know, the Bureau has authority over a number of U.S. laws relevant to the use of consumer data in credit underwriting, including the Equal Credit Opportunity Act and the Fair Credit Reporting Act. Alternative data, therefore, comes up regularly in our work in those contexts, among others. The Bureau recently formalized its interest in early 2016 by establishing an alternative data working group, as Albert mentioned. The group consists of stakeholders from across the Bureau who have diverse perspectives on the risks and benefits of using alternative data and modeling techniques in credit decisions. The group is currently in learning mode, which is why we're so grateful for the opportunity to hear your feedback here today. We've engaged in several listening sessions with external groups, including industry, consumer advocates, other regulators, academics, and consultants. And as David earlier mentioned, we released a request for information on February 16th. We released that RFI in conjunction with a field hearing that we held in Charleston, West Virginia on that same date. You can find the RFI on our website, and comments to that RFI are due by May 19th. The RFI generally looks at three basic questions. The first is, what type of data and model governance is out there, and how are companies using it currently or planning to use it? This question is relevant to both our attempt to gather information generally and also to our attempt to flesh out what's really going on in the real world, as opposed to what's being hyped up in the press. So, for example, it may very well be that companies have figured out how to underwrite someone based on their pictures on Facebook, but our question more specifically is anyone out there actually using data for those purposes in that way? And related to that, if they are using it, we are interested in learning about what type of procedures they're putting in place to monitor their risk and ensure compliance. A second question involves the potential benefits and potential risks to consumers and the market from using alternative data and modeling techniques, and Albert and I will go into some of the potential risks and benefits that the Bureau has identified in the RFI in a couple of slides. And finally, we're interested in finding out how stakeholders view and understand the application of specific statutes and regulations to the use of alternative data and modeling techniques in the credit process. Oops. Okay. So it's important in engaging in this discussion to establish a common understanding of the various terms that we use in the RFI. When we talk about alternative data, we are not using a normative concept, but rather a relative one. So we're talking about alternative data as it can be contrasted with data that's traditionally used in the credit process. So with respect to traditional data, we understand traditional data that's used in the credit process to include things that are commonly included in the consumer's core credit file. And in addition to that, any items that are regularly provided in the process of applying for credit, such as the consumer's reported income or assets. Alternative data is, in essence, anything outside of that core traditional data, including data that isn't necessarily held by a consumer reporting company. And we want to make sure that we distinguish the term alternative data in this context from another commonly used term, big data. We understand big data to be a reference to the volume or speed of the data and not necessarily the kind of data that's being used. With respect to modeling techniques, we understand traditional techniques used in credit decisioning include linear regression or logistic regression models, whereas alternative modeling techniques can include other types of techniques such as machine learning algorithms and the such. The request for information asks questions about the application of alternative data and underwriting methods to the credit process. And it's important to understand that that's a very broad concept in that it includes not just the credit decision itself, but also related processes such as all underwriting, marketing, pre-screening, fraud prevention, servicing, and collections. That keeps happening. Yeah, it jumped to another presentation, I'm sorry. Okay. Yep, we have the handout, so we can turn to that. I think I'm turning it over back to you.
Great, thanks, Sherry. So, notwithstanding the definition for alternative data that was described in the RFI and used by the Alternative Data Working Group, we recognize that the line between traditional and alternative data can sometimes be blurry. So, slide 9 tries to walk through some examples of alternative data. And these examples are meant to sort of traverse the broad spectrum of what might constitute alternative data, ranging from data that's more closely related to traditional data to those forms of data that are less closely tied to traditional data. And as the Deputy Director had mentioned in his remarks, we recognize that many of these forms of data have already been used for quite some time now, in particular by community banks in a judgmental way. So we are not certainly sort of suggesting that these are brand new types of data that are being used in underwriting. So on one side of the spectrum, you have what's commonly referred to as trended data, which looks at patterns and trends in traditional data over time. So for example, that would be alternative data, for example, that looks at whether or not credit card balances are rising or falling over time. Next, you have, for example, payment data that's not precisely credit related, but at the same time says something about potentially a consumer's ability or willingness to repay obligations like his or her cell phone bill, rent payments, insurance premiums, or utility bills. You also have checking account or deposit account information, which might look at the pattern of withdrawals and deposits, both from whom and to whom, which might also demonstrate a consumer's ability and willingness to repay. Moving further away from sort of core financial product, there are a variety of stability measures that could be used, like the number of changes in residence, number of changes in employment, and the like. There's also other forms of data that might say something about future ability to repay, including data about a consumer's educational or occupational attainment, like the degrees obtained by the applicant, the job positions held, or the schools attended. And then further afield, moving to the opposite side of the spectrum, you might have behavioral data on where consumers shop, where they travel, as well as how they might interact with a website. And then maybe moving even further along that spectrum, you have data about a consumer's friends and associates, including their social media information.
Question about that, if I may. How does that relate to creditworthiness?
Well, ECOA does have some specific provisions with respect to marketing and advertising, but certainly you can imagine that if you're not marketing or advertising to a particular group at all, that would sort of affect their ability to sort of be approved or have access to credit, which would likely have some fair lending implications on the back end.
And maybe I don't think that answers the question. I understand how all of the other factors on the previous slide relate to, or could relate to ability to repay to be used as a substitute for a credit history, a credit score, except for the final one. Can you help me understand? If I don't have credit history, but I have friends on social media, what does that have to do with my ability to repay?
Sure, and to be clear, it's not entirely clear what necessarily is the relationship with creditworthiness, but there are some folks who have been reported in the media who suggest that the creditworthiness of your associates might say something about your creditworthiness, and that is, of course, something that would need to be sort of stress tested or evaluated.
I think some online lenders would suggest that it's useful that a fraud detection mechanism, that if you have somebody who doesn't exist and has no friends, that maybe they're phantom people, or that maybe actually, and I'm not saying agree with any of this, or maybe that a consumer's at least willingness to, if you know that, I know that you're friends with these 7 people, all of whom I know, that gives me more assurance that you're likely to repay me and not stiff me.
Well,
Not saying that's true or not, but that is the hypothesis.
I have friends who have good credit, and I have friends who have bad credit. They're
Right.
still my friends.
That's the
Jonathan?
determination. That's really the question that's at hand, I think, with all the data points in some regard, is what is the reliability of these? I got a feeling because at the end, there might be some natural selection there, but that is
Jonathan,
the
for
question.
what it's worth, you've hit upon a source of considerable feedback to the Bureau when we publish this RFI.
So moving on to slide 10. Slide 10 summarizes some of the potential pros and cons associated with alternative data use, at least from the perspective of the consumer. And these pros and cons are listed in our RFI. Sherry and I will discuss these in sort of greater detail in subsequent slides. And of course, the goal of pointing out these potential benefits and risks is to help facilitate a frank and full discussion about, how folks might mitigate the risks associated with alternative data, while at the same time realizing benefits. Moving on to slide 11, which speaks to potential benefits. The key potential benefit that's described in the RFI is the one that I had alluded to earlier, which is the prospect that alternative data could expand access to responsible credit by giving those without a credit score or traditional credit history a different way to demonstrate creditworthiness. Another benefit could be in making credit risk assessments more accurate or more predictive. So for example, a lender with a 680 credit score cutoff might, with alternative data, be able to distinguish among those with a credit score lower than 680 as to who is more likely or less likely to go delinquent or default. And this in turn could potentially allow that lender to relax perhaps their minimum credit score eligibility requirements and as such expand access. Another potential benefit could be more timely information. So to the extent that alternative data reduces the inherent lag time between when consumer behavior occurs and when that behavior can be considered in a creditworthiness assessment, this might allow lenders to distinguish between past financial problems and emerging ones. And then there is the potential that alternative data could lower costs if it allows for the automation of processes that replace or are a substitute for more costly manual processes. And so potentially these cost savings could be passed along in the form of lower prices to consumers, or could enable lenders to make smaller loans more economically. And I'll turn it over to Sherry to speak about some of the risks.
So first, it's important to note that many of the risks that we're going to be discussing and that we note in the RFI also exist with respect to the use of traditional data or modeling techniques. We've simply tried to highlight risks that may have unique implications in the context of the use of alternative data and modeling techniques. The first risk we point to here is privacy concerns, whether that's because the data is of a particularly sensitive nature or because consumers simply didn't know that it was collected or would be used for the purpose for which it was used. We also may have concerns about, there also may be risks related to the quality of the data, especially to the extent that it's kept by entities that may not comply with consumer reporting obligations. There may also be concerns related to consumers' ability to control the data, whether it's because they don't have access to the underlying data or can't correct any inaccuracies that they spot in the data, or because the data is not actually about them, going back to an earlier conversation, but rather about their peers or about groups that they may belong to. There are also risks inherent in the complexity of the data that's being used or the modeling techniques that are being used. Obviously, the more complex and the more numerous the factors that are used to evaluate someone, the harder it may be to explain to that individual why a certain credit decision was made. Okay. There may also be risks related to barriers to mobility to the extent that the use of alternative data could potentially penalize or reward certain groups for behaviors in ways that reinforce existing social barriers. Finally, there is the potential for discrimination. Using alternative data may in some ways present a greater risk of unlawful discrimination on the basis of a protected category such as race or ethnicity, especially where we do not yet understand the potential correlation between a piece of data and a protected class. And finally, there may be violations of other laws, such as the Fair Credit Reporting Act or a violation of the prohibition against unfair and deceptive acts and practices. The RFI generally seeks feedback on the potential for these risks, the extent of these risks, and today we wanted to take the opportunity to seek your feedback on that same issue. And so with that, I think we're going to turn it back to David to tee off some questions.
So with that presentation, and thank you, Albert, thank you, Sherry. As we talk about alternative data in community banks, maybe I would throw it out to the council relative to think about what types of alternative data do you use currently or have you used in the past? And maybe start from that and then work our way forward from there. It's kind of a big topic to get our arms around. So I don't know if there's any, Angela, you'd like to?
I can start out, I know within the decisioning world, especially in mortgage lending or anything like that, a lot of times that you are going to have alternative data options when you go into a government rural development loan, FHA loan. When you do a manual underwrite, you might need to grab, so there's no credit report and there's no score, but they can still guarantee that, and you just need to grab different sources. Maybe you're going to grab, you need a 1 year with a 1 times 30 max late on it from a phone bill or a utility bill. I know prior I've done one from a local oil company that somebody had gotten their fuel oils from for the last, quarterly paid, so then we kind of adjusted that way. So it's just, I think there's a lot of options out there that currently we are using as alternative data versus on a debt side anyways, versus just the traditional credit report style.
And I would have to say, just kind of going back to some very simplistic models, if we go back in a very traditional community bank, were the days of when you walked in with your parents or you walked in with a person from the community and they quote unquote vouched for you. There was a character reference, if you will. And that type of concept from an alternative data standpoint goes back to ancient China, quite frankly, when you had savings circles and people vouched for each other and pooled their money together to loan to an individual for a certain event. And so there are still, I think, potential profiles or social aspects that may come into play. Obviously, those are softer factors than your traditional credit box, but I think those are types of practices that you saw with banking in the past. As we move forward, obviously there's, Angela had mentioned, whether it's utility bills or rent or cell phone or cable or utility, all those regular type of payments are items that you fill when there are gaps. I don't know if there's any other examples of what people may use. Oh, John?
We look at their deposit account, if they have one with us, how they've handled it. Many of them will have had savings accounts from when they were kids, and we give them credit for that.
So the length of that relationship and how they've handled that relationship. I think you see the same thing sometimes with small businesses and their merchant accounts and their transaction volumes, or deposit volumes as a proxy for for income.
How about things like where people work or what their occupation is, or Is that stuff that factors into your underwriting decisions? Jack, do you wanna-
I would say yes, it does. I talked earlier in a group that, one time before a car dealership had sold out, we had a fairly large population of immigrants moving in, and they'd be brought into us by this car dealer and basically vouched for. And very few of them could speak English, but they managed to get their transactions done. But that's how we did business, basically, was vouching for them. On another source, we do marketing for credit cards on a large basis. I would call it a near prime, but we reach to what I'd call the thin files. They have to have a file, but it's probably a thin file. There's probably 200 data points within a thin file, and we are constantly researching which ones are likely to pay us back out of all those data points. I mean, it's a lot of testing, it's a lot of work, but that's something that we work on, and I'd call it a near prime type product.
And I can just speak kind of specifically to the employer channel. We have an employer loan program, and I would say that the length of employment seems to be a factor of stability. I would say that when you dig into that employer, what type of employment it is it part-time, is it full-time? And that really, it speaks to the volatility of income, whether it's consistent or inconsistent, has obviously some repayment characteristics to that. And so those are things I think in that employment space that we do find or are seeing that are very credible.
I think also on the employment, just to add on to that too, sometimes you're going to see that you want to, I found especially in the agricultural, when you have somebody who is farmhand style or anything like that, they get paid in a different way, it's a seasonal piece, and their employment is different. So you all are looking for alternative ways than the traditional employment verifications or anything like that for those. And generally, the secondary market stuff isn't going to accept it if it's a handwritten check that the farmer gave to the farmhand, and then they get a free rent home as a payment source. So you have to have those alternative issues and help for those items as well.
I would also say that there's some other, they're not maybe naturally occurring, but they're regular payments. So there's an example of if you're a cash farmer, there's a cycle to your cash flow, right? It's annual. So your mortgage payment may need to be annual as opposed to monthly or quarterly to meet that. It's another thing that's similar to, let's say, a tax refund, where you consistently see someone get a tax refund, and they can use that either to repay debt or as a savings. You're looking at a specific event, but you're familiar with that, but it doesn't show anywhere per se. But there is, again, some of that trust as to you didn't change your deductions, you made the same, okay, then there's some reliability around that.
I can say in our area, which is very small, rural, and it's agricultural too, we really don't have the instance of people with no credit. Maybe that's more of an inner city, I don't know. The people that would come into our bank that would have no credit score would be young people, in which we help them establish a credit score, starting with minor loans or car loans, so forth and so on. Bigger issue for us with people that we do all the time is do figure out why their credit is bad and get to the bottom of that and help them straighten that out. So it's not, for us, it's not an issue so much of alternative documents, it's more figuring out and helping them get their credit straightened out. So we just don't have a lot of people that come in without a credit score. We have way more that come in that need help getting it cleaned up. And that's just in my small area.
But are there times when a consumer will come in, if you look at the credit score, say, no way, based on that credit score, would I make a loan? But you know something else about the consumer, or you do a process which leads you to think, yeah, this consumer is somebody I'm willing to make a loan to, even though the number doesn't say that.
Definitely, because the number could consist of a cell phone collection issue. Now, the cell phone people do not report monthly that this is a good customer paying their cell phone bill. However, they can turn it over to a collection agency, and then it does end up on their credit report. The same with medical bills. If we have a customer come in and they have issues with, and it's because of medical, we throw that totally out. I don't think it's right. These people, first of all, they may have issues with their insurance company, with their doctor, with the hospital. Has nothing to do whether or not they're paying their other mortgage payments or car payments. So we throw that out, and truthfully, I wish the industry would throw those out. For one thing, they have enough problems already, with the medical issues. So we tear that apart. So
For
we
you,
don't,
not so much bringing new information into the system as
Correct.
discounting stuff that you think is not
Disseminating what's out
probative,
there.
but that the traditional system thinks is
Yes.
overweighing.
yes, at least that's my experience.
I'd love to hear from the council members on how you feel that alternative explanation is holding up in present day. We used to be able to mitigate or tell a story of a divorce or a life event of some kind or a medical issue and write a little note in the file and you're good. Now, if the metrics in the box of the credit box doesn't quite fit, that story doesn't go as far as it used to. And I don't know if you want to talk about that. I think that is an issue.
I do think that's, from a fair lending perspective, as a fair lending officer, I'm fully aware of those type of situations that come up. I was a former lender also and an underwriter, so I understand that. But the way that the banks are being drilled and from a regulatory perspective, it's scary. I mean, whenever you make an exception, you almost have to write a book to explain why you're making that exception, and you better be consistent. That's the bottom line, is you've got to be consistent, from borrower to borrower. Because, similar situated type scenarios, they better match as far as pricing and fees and all of that. It's huge, and it's scary.
We've actively been doing loans with alternative credit for years and still continue to do them. I have the same concern about fair lending. I think as we broaden this box, that the regulators will get a hold of it and we'll have to continue to defend it. To date, that's not been an issue for us. My concern is if we prescribe what you can look at from an alternative credit source, that will narrow our opportunity to help consumers, because not every consumer is going to have the same opportunities for identifying what their alternative credit might be. And so I think we need to be very careful that we don't prescribe what it is we have to look at. We might be able to provide suggestions of things we can look at, but not provide things that we have to look at in every case.
One of the things this committee has talked about at length today is the degree to which community banks rely on service providers. And conceivably, as you think about alternative data sources, many community banks are going to have to rely on companies that are producing models that they could use in some cases. Not everything can be a completely manual, subjective decision as much as we try. So I think that inherently will raise concerns over cost. To have access to that data in Reg B, what is it, empirically derived, statistically sound, I think is the correct terminology. So there's going to be a cost aspect. I also worry is if the use of alternative data can help but not hurt, it makes a lot more sense to me than if it becomes a straight up underwriting consideration where actually alternative data may actually hurt you. So I think that's an important question to wrestle with. Can it be used to put you over the bar, but at the same time it shouldn't actually hurt you nonetheless? Because now all of a sudden it raises all kinds of concerns about disputing the accuracy of the source of the alternative data, and then it seems to get very ugly quickly there.
Sorry, go ahead, Jack.
Just to dovetail a little bit onto Trent's comment, we just had a model that we wanted a validation of, and I'm going to tell you that was $135,000 for the validation. So when you develop these models, to Trent's point, they're unbelievably expensive when you start developing them and make them, pass the regulatory muster.
I would say if.
In one of our areas, we look at whether the individuals that have applied have worked successfully with another organization, such as Habitat for Humanity. I mentioned the Workers Investment Board, or the youth program that we have through our county. So if they're showing success in those programs, which are designed quite differently from what we're able to do, we're more apt to sit down with those individuals and put them into a program that is viable for them. One of my concerns, if I could, the data that you quoted, I wonder, for those that with no credit or inadequate credit available, are these groups aggregated in regions that are underserved by true traditional community banks? Or has that analysis not been performed?
I'm not sure if that analysis has been performed, but as I mentioned earlier, I think what the Office of Research did find was that folks from lower income areas were disproportionately affected by this issue, and I'm not sure if there was a correlation between lower income areas and sort of whether or not those areas are underserved by branches, for example, or banking.
Another key element in all of this is that for most of us with sort of non-traditional approaches, it sort of starts with, what do we have to work with? Do you have a job, and can we work with that record? Do you have a cell phone, and can we check the payment history? What's incumbent in so many of the examination processes we go through in fair lending is to do the same thing repetitively. So if 11 different people come up with an alternative method that they did, it really sort of drives that we each consider each of those. Do you have a job? Do you have a cell phone? The laundry list of what you have to go through is part of where the debilitating decision process goes through. It used to be sort of unique to the consumer, and now every time somebody comes up with a new idea, it really drives us to gather the data for all consumers in that set, and that becomes cumbersome.
I have just a very quick concern on the alternative data usage and creating a module for that, or a platform that you would think that would be, because I think that almost takes away from the ability to have it so unique to the situation if you're trying to drive it into one of those items. So that's kind of a concern as well, is if that's something that's being more and more thought through. You know, there's a piece where you can do that and you're going to enter that information, but at the end of the day, to keep the uniqueness to what it is, the alternative data is going to be unique to regions, to areas, to persons, to everything, to the bank. So I don't know that you can just put that into an AUS system and then just have an automatic system that does that.
Does it need to be either or can it be just dependent upon the situation for that particular bank in that particular area?
I would think it would depend on the bank, but I don't know that you could have one or the other. You need to keep the openness for the alternative data to be used within the community bank settings.
Is there information today that you would not use, even though you think it's relevant in making a credit assessment because you're concerned that too much fair lending risk or too much privacy risk, whatever it is, that where the law is constraining you from using information that you think would be is actually relevant and you'd like to use, or you just?
Yes. There's a particular sect that we know will pay their debts because of their cultural norms. And I can think of a few that I would never document it, and I would certainly use it as a primary means of making the lending decision, which we have never done. But I can see that being used, and quite effectively.
I think we'd probably never use place of employment, type of job, degree, university graduated from, or type of education. Maybe to Jonathan's point earlier, the social media piece. I think those are areas that would concern me from a fair lending perspective.
Would you not use them because you don't think they provide valid information, or because you would get in trouble with your safety and soundness
Yes.
regulator, or are there other
Fair
reasons?
lending.
Fair lending, yeah.
Well, one example is if I, as a loan officer, have a relationship with the applicant, a personal relationship, a friendship, because we live in the same community, we see each other at church, for example, I can't use religion as a factor. Maybe we're in the same kind of social circles, but that has, like if I treat people in my social circles differently than people in other social circles, that could be dangerous. But it could be relevant in establishing, a history, a relationship with the applicant that could be relevant in their assessing their likelihood of payment.
But try documenting that in a file and see what happens.
And to Jonathan's point, we traditionally are relationship lenders, live in small communities. We know their family, we know what house they lived in when they grew up, and these are things that help us make credit decisions, but fair lending has pushed that out the door because every time we make an exception, we're putting our organization at risk for, having to spend the money to answer it or be fined. And the reality is that, those relationships are important in evaluating credit decisions. One of the best things we do is get to invest in people and help them achieve their goals in life, whether it's their first new car or their first new home or whatever it is. And frankly, regulation's taken that out of the equation. I mean, because every time we make an exception, we're at risk for a fair lending violation. And yet, in the case of Jonathan's point, those people he knows from his circles, he knows enough about them. He knows their character. Character is a huge factor when you consider the C's of lending. I mean, it is. And, in my community, we have very conservative. We look a little bit at what they've been able to amass without credit. I mean, because frankly, we have a lot of people who don't borrow money. They just earn it and buy things with cash, period. And so one of the things we look at is, okay, what do they have now without that credit? Because frankly, it tells us they worked for it.
In prepping for this, I did some research with some micro-lending organizations that operate around the world, Central America primarily, and I mean, credit scores don't exist, and how do they make their credit decisions, and how do they operate predictably and successfully for decades on end? And the key decision element that describes the successfulness of a borrower repaying is trust. It's the trust that exists between the borrower and the lender, and that comes in two formats. One of them is, of course, that if the borrower repays the loan, the trust is instilled and there's a likelihood of having the money lent again. But most importantly, it's the desire not to let the lender down. It's that personal bond that exists. And where this is relevant is on two fronts. First of all, this is what happens around the world consistently where things like FICO don't exist. But also, it's inherent in the root of everything that's being said around the table. The trust that we develop with the people that we get to know has an element of subjectivity to it, and yet it's still rooted in trust. So all the data in the world, based on this micro-lending environment, suggests that whether you know that somebody's only had a one-time 30 on their cell phone, it isn't necessarily more important than the bond that comes out of the discussion between the two people.
I'd
go
like
ahead,
to say
please.
something. I'm a prime example of a single mom with a child that never had a credit score because I didn't have a job because I got married straight out of high school, got divorced, had a child. I would have never had an opportunity to hold a job because I wouldn't have been able to buy a car had the banker that loaned me the money to buy my first car not loaned it to me because he knew my dad. And he knew if I didn't pay, my dad would kill me, so he made me the loan. We can't do that anymore. We can't help people get started like that anymore because we know their family, just like he said. We know the family, we know the culture, we know the character. We can't do that anymore. So our hands are really tied to help people get started. So the use of alternative data and means by which all we're going to use it for is to try and justify why we made them the loan. Their rent, the landlord can write us a letter. They can buy a house on a contract. They can bring in their receipts. But we struggle as community bankers and try to help the people like we were helped, to give them the opportunities that we had to get a loan that we just can't make them and justify without getting our bank in trouble anymore. So I think I'm really happy that they're looking at this, trying to find a way to justify us being able to use it. But I just hope they don't tie our hands and list what only we can use. And I hope that that doesn't convert to hurt people rather than the ones we're able to help now and not be able to help them again because our hands are getting tied. But so that's all.
Thank you. Well, Zixta, with that, I think they answered your question to start with, that they will hold off from taking things like credit bureau in light of fair lending. So there is a risk trade-off between data. And I think it was clear by the room that our communities are our third regulator, or fourth, depending on how you do the math every day, in the community bank space. So Albert and Sherry, thank you very much for that informative presentation and an energetic discussion. I think there's more to come on this topic. During our next discussion, we will hear from the Bureau about the inquiry into challenges consumers face with accessing, using, and securely sharing their financial records. Today's discussion will focus on what risks are for community banks, and also what kinds of services or products do community banks use that potentially aggregate consumer information. We will first hear from Bureau staff Will Wade Gary, Assistant Director, Card Payment and Deposit Markets, and from Stephen Shin, Managing Counsel, Office of Regulation, who serve as Bureau experts on these consumer access to information issues. Gentlemen.
Thanks very much.
Thank you.
I'm Will. This is Steve. We're here to briefly describe the Bureau's work on Section 1033 of the Dodd-Frank Act. Why briefly? Well, first, because David Silverman already gave you some of the high-level summary there. And second, because, as David Reiling said, we're really here to hear from you. Let me just quickly go forward here. So I know this is an issue from reading the comments that community banks are far from indifferent on, so we would very much like to get to the part where we hear from you. So let me run through this briefly. I'll take a quick overview of background, and then Steve will cover the RFI that we did at the end of last year, and summarize some of the information that we learned back from that, and then we'll get into the discussion. So just starting with the first bullet here, very briefly, the Dodd-Frank Act provides for consumer rights to access financial account and account-related data in usable electronic form. If we skip to the next slide, you can see that in more detail. This is Section 1033. But in brief, it says a covered person shall make available to a consumer upon request information in the control or possession of such person concerning the consumer financial product or service that the consumer obtained from such covered person. There are a number of exceptions written into the statute. Here we have a few of them listed. The information must be in an electronic form that's usable by the consumer. The information does not need to be there is no additional obligation created by Section 1033 to maintain data that otherwise would not be maintained. It is not a retention obligation. And it applies only to data that the account holder, or the financial account data holder, the provider of the account, can retrieve in the ordinary course of business. There are other exceptions too that I think are fairly important. It doesn't apply to proprietary information like credit scoring algorithms. It doesn't apply to fraud control information or the like. We just flip back a second. This gives a little bit of a history of our work in the space. We launched our inquiry into sort of sharing practices, issues that are implicated by Section 1033 at the end of last year. We then launched the RFI. I think sort of the core of the RFI is trying to understand essentially what sharing is occurring, what sharing may not be occurring because of certain obstacles, what are the costs and benefits, risks, and so forth to different participants in that sharing ecosystem, consumers very much included. So then if we move on a couple of slides, let's just talk briefly about current market practices. Obviously, what you have here is you have a range of entities from traditional depositories of various kinds to newer fintech providers using account data in various forms obtained from financial institutions to provide sometimes new, sometimes existing financial services, financial services that are already being provided by DIs, but maybe these would compete with them. Sometimes they're newer services that aren't yet being provided. Many account data users do that through aggregators because account data users may go get account data from a wide range of sources, and because of the transaction costs involved, they may choose to do that through specialist aggregators rather than doing it themselves. We see in this ecosystem a wide range of different sharing practices. Obviously, we all know about screen scraping. There are other methods of sharing data that exist here, various forms of structured data feeds, APIs, and so forth. We also see different authorization channels. So obviously, we're used to the notion of, in the screen scraping world, the credential, consumers have shared their credential, and that is effectively serving as the form of authorization. But there are other forms of that exist. You see OAuth, for example, before the use of a structured data feed or an API. So different channels, both for authorization and for actual data sharing. And then a recent trend that we have seen is more players in this space, particularly larger banks and larger aggregators, and negotiating bilateral deals for sharing this. At some level, there have been a range of bilateral deals negotiated by aggregators with banks for a long time. The scope of the deals appear to be broadening. So just quickly running through some of the consumer benefits. I think one that we're all probably relatively familiar with is sort of the PFM, personal financial management tools that exist in this space. This was perhaps one of the first uses that were made of it, made of data, and often it was actually done by traditional DIs, not by newer players. Other potential benefits, sort of automatic or motivational savings apps of various kinds, which can provide savings advice. They can actually provide sort of messaging at select moments. They can provide algorithms that help determine the amount that you can save and give you advice on that basis. Budgeting tools can be very similar, perhaps with a broader focus on budgeting as a whole, not simply for savings. Product recommendations are a fairly big category. That comes in a variety of shapes and forms. There are some apps that use data to advise you what to use in terms of products that are in your existing wallet. I'm familiar with my card hat on of one that tells you which card in your wallet to use for maximizing your rewards earned. But there are other product recommendation tools that tell you that, they analyze your transactions, then tell you that you're using a debit card that has a high ATM fee, and you maybe there would be a better product available to you. There's a wide range of things in that bucket. Account verification is obviously a very important category. Some of the aggregation tools may be able to sort of move beyond what we're doing with things like micropayments and so forth for account verification. Account verification obviously being critical to obtaining numerous consumer financial and non-consumer financial products. Loan application information verification is sort of a subset of that. Credit decisioning is obviously a very large category and relates very much to what we've been hearing in the first presentation. Cash flow management, again, I think a sort of version of some of the budgetary type tools we've already discussed. Funds transfer and bill payment is a very big category. Most of the ones that we've talked about to this point are more about data analysis per se. They may have a messaging component, but they don't actually then transact on your basis. But some of these add a transactional component as well. That might be for a variety of purposes. It might be to make payments for your bills in a timely manner. It might be to make sure that you transfer a certain amount to a retirement fund on a timely basis. There are different versions of that, too, that may tell you when you have available funds and so forth. Fraud and identity theft detection is a fairly large category. We're always familiar with that on the supplier side, but some apps actually provide that information directly to consumers by identifying, by running through their transactions and trying to spot fraud patterns. And then obviously there's the investment version of the things that we've been talking about from a consumer point of view. Current market issues and risks, if we flip over. These are fairly broad buckets that cover a wide range of issues. You could disaggregate these further and generate a longer list. This is a fairly high-level aggregation. Data access issues, obviously there's a range of access practices that we are seeing. In some cases, we see prohibited access. In other cases, we see access that is allowed to the consumer but restricted in various ways. Maybe that's de facto, maybe that's de jure. We see certain conditions on access and so forth. Data security, obviously this is a major concern, and it is one that we heard a lot about from commentators on all sides of these issues. How do aggregators and account data users get this data? Do they do so in a secure method? Do they keep the data in secure ways? What regulatory regimes apply to them or should apply to them? Should they be treated differently from account data holders now? If so, why? Or why not? Related to that, sort of the security and privacy issues around retention and reuse. Do account data users obtain this data and use it for, or hold it for longer than they need? Or use it for purposes other than those that the consumer may understand that the data is going to be used for? Another critical issue obviously concerns liability for unauthorized transactions, for example, from the result of a data breach. This is a critical issue. One thing, obviously, that we hear a lot about in comments is sort of which party in the chain may be responsible for this. We're obviously very focused on the issue of ways to enable sharing that don't create liability for the consumer. But obviously, we're also concerned with the allocation of risk as between parties in the sharing system that aren't the consumer. FCRA issues are obviously very significant in this space. Similar with privacy, how does GLBA apply here to the aggregator or to the user? How does the FCRA apply? who is a CRA in this space, are aggregators CRAs, are account data users CRAs, under what circumstances, are account data holders, are they furnishers of data, and under what circumstances, and what are the implications of that? Then obviously there are a large quantity of technical burdens. There are technical burdens associated with being screen scraped. There are technical burdens associated with rolling out a system to put in place of screen scraping. There are technical burdens associated with different forms of authorization channel. There may be technical burdens associated with delivering to the consumer various services that may enable them to control the flow of data. Consumer dashboards that would let consumers, for example, turn off data sharing at certain points. A wide range of technical burdens, again, that we heard a lot about from the RFI. And on that note, Steve?
Thanks, Will. So, I mean, it's in that context of rapid development in the marketplace for products and services that have a lot of potential uses and benefits for consumers, but also, along with that, present new or potential risks as well. So we asked in the RFI, requested information and solicit input on a range of issues that we've been kind of discussing and touched on a number of topics, which we have listed here. But broadly speaking, we asked about industry practices and current developments and the various use cases for products and services that rely on access to consumer data and financial records, as well as very much wanting to hear about what benefits consumers receive and their experience with these products. In addition to practices and benefits, obviously we're very much interested in hearing about the risks and challenges and concerns related to accessing consumer data. And lastly, we requested feedback on potential market developments. Where do responders see the market going? What kind of developments? Are there industry standards that can come out from in the current ecosystem and the current players? And along with that, asking for perspective and opinions on what the Bureau's role in particular could be to foster an environment where there is a development of responsible and consumer-friendly innovation that benefits consumers. So as was mentioned earlier, there were over 70 responders. We also receiving feedback from all stakeholders. It was a wide range of responders. It was from financial institutions, big and small, account aggregators, data aggregators, information users, consumers, and consumer interest groups, as well as trade associations. In particular, we did receive comments from trades that represent the interest of community banks. And while many of the commenters agree that responsible innovation benefits consumers and customers alike, as was mentioned before, we did hear a number of concerns in some that we kind of listed out in terms of the risks that we were kind of aware of, but also, that list is generated from the feedback that we are hearing from financial institutions in particular. And again, on a high level, those deal with data security and increase of potential fraud, privacy concerns, as well as burdens and increased costs, especially as they apply to community banks. At the same time, we also heard that whether anecdotal or from various feedback, that there are some community banks that are actively partnering or looking to partner with or develop innovative products and services that rely on consumer data. I think in recent developments, we do hear kind of market announcements about partnerships, about using data aggregation in order to kind of deliver products either more efficiently or faster or a smoother consumer experience. So I feel like, with that, probably turn the discussion over to the advisory council, because it sounds like, at least our impression is that they're both, the concerns, but also the benefits, are being highlighted by community banks.
Well, thank you, and thank you for that presentation. At this point in time, maybe we can gain some perspectives of the advisory council. Please, Trent. Oh, sorry.
I'll go this time, Jack, and you get the next one.
You go next.
We're in the nationwide prepaid card issuing space, so we have customers sort of all over the place. And they typically take advantage of a lot of the providers that you listed on the slide, the 12 or 13 types of data sharing that's going on. The one thing that is the greatest challenge for us, and I'm sure many other banks, is that right now Reg E, in my mind, is completely ill-equipped to deal with this phenomena and this desire of a consumer to take information and move it to, or have it moved to another provider, and then lo and behold, something bad happens. Right now, we start with the premise that it's the bank's liability in many cases, or they at least know us, and so we're the first place they call, because it's easier to deal with us than it is to deal with XYZ FinTech in Silicon Valley. And so I think my concern is that I believe the banks right now are sort of propping up that side of the industry because they're not having to deal with the liability questions and taking best practices for securing information and not sharing information, and then standing behind financially when something doesn't go right for the consumer. So I think just at its core, Reg E needs an overhaul to accommodate this particular issue, and specifically needs a very clear line of demarcation between banks' liability starts here and stops here. And no matter what happens post that line, the bank's line is right here. And it's not there today.
Just to touch on that, and I was going to go into the Reg E because that's obviously a huge concern from the banker's perspective, but tapping onto that, we have a duty to make the data available to the consumer. The consumer doesn't necessarily mean the third party in my mind. So if we're making it available to the third party, that opens up a whole other Pandora's box. And it requires third party oversight by us. Huge with our regulatory bodies right now. Who are we doing business with? Who are we allowing to do business with? And are you doing your due diligence on them? I'm not going to be flying out to the Silicon Valley every other week for every new startup to do due diligence. I can't afford to. I spend on an average year at least $250,000 on data security. I don't know what they spend. I haven't got a clue. I mean, they might be running out of their garage for all I know. Yeah. So, and these partnerships you're talking about with banks, to my opinion, this is another one that I know that the OCC has been all over it. A lot of it is what I'd call rent-a-charter. They're paid a fee for a transaction or per record that are coming through. So they're looking at it as a revenue source. So I think there's a fine line on where we're at here. They're doing it for financial reasons. Are they doing it for any other reason? I question that. So, and when you start looking at what they're doing and why we might be not wanting to share our data, some of those are our competitors. Do we want to share that data with our direct competitor? And I would argue I don't. At our cost.
At our cost, yeah.
And our liability.
That's
where so when you see the pushback, that's just a handful of the pushbacks. Can I see some of the positive? Yes, but we try to offer as many of those products as we can within our bank. We have the budgeting. We'll text message you when your account's getting so low. We'll notify you of unusual transactions. Is this you? We spend a lot of money on this type of stuff. So why do we need to go out and outsource it to another third party?
I agree with that, and I think, with some of these third parties, we don't even know who they are. Like you said, they could be out of their garage, they could be 2 or 3 people that have a small business, and they're not well capitalized in some cases. So how are they financially responsible or liable? I think the liability issue is huge for financial institutions.
We already have a liability right now. If someone has their credit card on their cell phone and they decide to take the password off their cell phone so they don't have to put in a password to use it to buy something, and someone takes their phone and buys a lot of stuff, the bank eats it. It's not their responsibility because they gave the password away or didn't have one on there. We're responsible, and that's the credit card industry putting us responsible, and we can't fight that if we want to have a relationship and offer a debit card at all. So we already have that huge liability. So of course we're going to fight a customer being able to give their information to anybody, because at the end of the day, it's going to be us again that eats it and that has the liability. So if we can be guaranteed the liability is going to be on the consumer or whoever has the information and have it in writing, it'd be a lot easier for us to open something up.
There's a catalog of regulations that I think has to be looked at along with this. My bank is a charter that's 10 years old. It was built around the electronic delivery of statements, both on the loan side and on the consumer side, sort of built around this whole idea. And the one that I scratch my head at all day long is e-sign. So in order for me to open up an account for a customer who willingly comes wanting electronic statements, opting in, no problem. Right, 2 elements to e-sign. The customer has to voluntarily opt in, but the thing that's arcane is demonstrated consent. So the consumer has to proactively show that they have the ability to open up a PDF. Now, the reg was written when no one knew what a PDF was, and now it's completely arcane. So I get the consumer set that we're talking about here who desires access to this information, who are frustrated by the fact that I either have to send them home to log on to the online banking, to open a PDF, to give me some form of demonstrated consent to prove that they can do it, or if I'm lucky, I have a consumer who has a smartphone in their possession right then and there, and then my staff can walk them through how to log on while they're in the, to do the process. There's a series of these things that really need to be looked at. There's innovators, there's entrepreneurs who say, hey, if the banking industry made this data more available, we could help consumers. But, part of the ask here with Reg E and things like e-sign, we could probably do a lot of things to not hamstring ourselves.
So I'll take,
I think that's very interesting on e-sign, the potential asymmetry of the application of that to, yes, that's, I'm actually not sure we've seen that comment in the comments, so.
Yeah, and it makes, it is what the regulation says, but there also is no, there's no latitude in how it is examined. It is examined 100%. We have to demonstrate it for the consumer customer on accounts and on the loan side.
Right.
So we can't send out electronic statements without going through this process. And it really gets kind of tedious because you not only have to take all the time, but you have to document it.
And that's true even for consumers who originate and service their account electronically.
Right, so the millennial that's just accustomed to doing all this information, they just don't even get it.
On the flip side to that, as community banks, we are dependent on data aggregators. We use them all the time, right? We have credit bureaus. Some cases you'll have a check systems or some type of system like that. There are legal background checks, identification like a LexisNexis type of system. And so we're very much dependent upon those data aggregators. Part of my worry, quite frankly, is can we still be in the game of data? Or is it so big and so expensive that the Googles, the Apples, the large institutions, if you will own it? And is there access? And so I guess my subsequent question to that too is, how do you get all these bunnies back in the box? All this data is out there in various places. It's not like I have the keys to my own financial and that I can choose who to give that key to. Maybe that type of scenario will work in a blockchain or something, but today I don't know how you actually pull all that back.
But if it's wrong, how do you correct it?
It's a great question. I don't know.
Can I ask how many folks here are offering their customers, services that require sort of consumer authorization to go get aggregated data services of one kind or another?
Yeah, we are.
We have Yodlee in our online banking, but what I find interesting about both these conversations is that the bankers are wrestling with regulatory burden and struggle, and primarily over enforcement of those regulations. And we feel like we can't help the consumer and do the things they want, and yet Silicon Valley can do it, and they don't have that regulatory burden, they don't have the same constraints, and yet that's what we sit here and talk about. Well, let's go let them do it because they're able to, but the people that should be doing it can't because of regulatory burden. And that's the part that's so frustrating. I mean, you don't think we want to provide this stuff to them? We want to help consumers. We want to be able to make these loans. We want to be able to provide these services. But the reality is that we're drowning in it. And we're terrified to do anything because everything we do is wrong.
And it's not a fair, as far as us and the large institutions, financial institutions, they have the resources, to implement all of this. We don't as community banks. It's not a fair playing field.
They have legal staff to
Right.
argue with the regulators.
Exactly.
And
Well, I would say this, whether we like it or not, the digitization of banking is in front of us. And one might even go so far to say is that we're over the chasm or the tipping point to where the adoption of mobile and technology is now into the early adoption phase of the innovation. And so the access to data and the use of data, obviously a blessing and a curse, right? How do you use it? How do you use it safely? How do you get access to it and provide it in a way to the consumer that is responsible and secure? I think when we look at, I was kind of looking at the laundry list of all the regulations that we have to oversee when we're in that third party. There's privacy regs, there's a data security and BCP, third party risk, AML, BSA, and UDAP to kind of wrap it all together. I mean, it's just kind of, I think there's a lot of regulation on there, some of which, as we discussed, may need to be modernized to what's happening, of which there may not be an end to the modernization, right? We'll modernize it to today's standards, but 2 years from now, we'll be saying, wow, is that antiquated in terms of its speed? I would ask one question, maybe from the approach of looking at this, particularly when you look at the feedback that you got from the RFI, is there anything or nuggets in there when, are there people making progress in these phases, or do you see a concentration in the large institutions, bank and non-bank? Or not enough respondents?
I think probably on the community bank side, I mean, because you're getting letters mostly from trades, that sort of tries to provide a holistic perspective, and that then, I think, gets a little hard to sort of unpack that and go, are there players within this realm who are very far ahead of this? I mean, some of the players who are further ahead than others, I think, while I wouldn't call them community banks, are at the smaller end of the large bank spectrum, which is kind of interesting. And they may see that as a competitive play, that if they're trying to play to millennials, maybe this is, it's not just that we're going to offer you the kind of services that you can get with aggregation, but we're going to make it relatively easy for you to share your data so that you can get these value-added services. I think, but within community banks, I think we've heard both demand for the services. I think something of a black box, to me at least, at this point, reading the comments, is to what extent do community bankers feel that their customer base wants to enable sharing to get these services, be it from them or be it from a third party. I certainly hear from community bankers that their customers definitely have a demand for PFM-type tools, but to what extent do you find, online credentials being shared and a lot of screen scraping taking place? Do you feel sort of the need to substitute something in that place, or is it not happening at a scale that is so?
I mean, I think the one thing I would add is that at least from some of the themes that are coming up in the comments, it's a tricky balance, because I think, there are even from financial institutions, kind of saying different things because there are different needs like kind of at this time. I think one, for example, I think many commenters said CFPB, whoa, like, don't rush into a rulemaking, for example. Let industry kind of figure some of these things out, whether we can figure out an industry standard. At the same time, there's also kind of calls for noting that, there needs to be a level playing field, that there are, for all participants in the ecosystem, because, there are a lot of regulations and requirements that banks have, which may or may not translate over to non-banks or some of the data aggregators. So I think, and so it's one of those things where it's essentially take your time, figure out and be aware of these issues. But if you're going to get into it, here are the issues that really kind of matter. So, and I think that there are, development, as we kind of mentioned earlier in the presentation, there are developments in the industry where I think there are some banks trying to figure things out, whether it's by bilateral agreements, things like that. I think it's an interesting question because it may turn a little bit on whether the interaction that you might have with the aggregator is via screen scraping, where you don't even know who who's requesting the data, versus ones where you might actually be thinking about engaging in some sort of agreement.
And potentially then presenting that information to the consumer. You are sharing with the following entities. Do you want to? Sorry, and potentially then sharing that information with the consumer. So the kind of screen that would tell the consumer, your customer, here's who you're currently sharing with. Here's who we're sharing with, as we understand it, because we have your authorization to do so, and here's what we're sharing. Turn this off now if you want to, sort of thing. Basically, you can't really do that if all you have is screen scraping coming at you and you don't know who's the other end.
I think and I haven't given this a ton of thought, but I think where the conversation is evolving is that we're really talking about I'm sure there's lots of different arrangements, but the two primary arrangements is a direct relationship between bank and third-party entity, where I can presumably exercise some sort of negotiation and requirements contractually around certain standards that I feel comfortable with that sharing happening. And then you have screen scraping, which is sort of, to some degree, sort of cowboy acquisition of information. Very soon I'll have to provide the Bureau with every cardholder agreement and every fee schedule that I offer in relation to my prepaid cards. And that's presumably that the consumers would find some sort of value in being able to do comparative shopping. If the third-party entities are within the realm of your regulatory schema, perhaps it's not too difficult for you to require some database reporting of them, so that the public and we can very easily go to a place and get some sort of level of comfort that, in fact, that third-party entity has passed some level of competency, that you would be able to easily explain their sharing practices. So we have some sort of comfort to be able to explain to consumer, hey, before you do that, make sure you go check this one out, because what we're seeing, it could be troubling to you. I think that's really it's impossible for us to educate the customer on all of the providers out there. So I guess if we're in the database business and we're in the comparative shopping business at the Bureau, this could be as good a use as any.
I would tell you that my consumers are very conservative and they don't want their data shared, yet they don't know all of the places where they're giving it away. And that's the part that's really maddening, and yet they often look back at us and say, are you sharing it? And, I make the point because a lot of times, for instance, there's the tax prep websites. You'll do it for free, but in that end user agreement, they're saying we get to sell your data, and it's everything you file on your tax return. That's what you're trading, and they're getting, a lot of money for that. And you basically would have paid $35 or whatever it was to file. And yet it's in this big, huge end-user agreement that nobody reads, and then that gets sold. And that's so true in so many places. And yet, as a bank, I have to conspicuously tell them, here's what we do in our data sharing practices. In fact, up until last year, I had to send it to them every year and say, here's what we do. And it's interesting, I see the ads on TV about the credit score cards. Well, we don't care if you're our customer or not. You call us up, we'll give you your credit score. Well, yeah, guess what? And then you're going to authorize that they turn around, they're going to get enough information about you, and they turn around and sell those to data warehouses. So there is a little bit of disparity in the marketplace that community banks and banking in general has to be upfront. UDAP again, there's another one of those wonderful regulations that we talk about, very conspicuous about how we're going to use it, yet the rest of the marketplace doesn't have to do that. And so there's an unfair competitive advantage. It just, and we sit there and say, well, either make it equality, either put them under the same requirements we have, and then we can all talk again, or give us the same freedoms they have, and I'm sure we'd be glad to do all these things for them.
In the comments, aside from the substantive comment of don't write a general 1033 rule, the overwhelming regulatory comments were about existing rules, and primarily focused on their asymmetric application.
If I can make a comment to the tech stack that, I would say banks in general, particularly community banks, have been quite good at the core on a data security standpoint. The core, even though it's somewhat antiquated, and we have our complaints about that, but it's been reliable and it's been stable and secure. The place where we lack is probably what sits on top of that base. If you picture a cupcake, that sweet spot on the top of a cupcake is what I would consider some type of flexible middleware. So you can plug in different financial technologies, yet still protect the core. Now, you still may have some relationships that you API direct into the core for business intelligence or specific product lines. So I guess the only reason I really bring that up is we're going to have to access different sources of data specific to the customers we serve. Generally, community banks will find themselves in spaces of niches. They have a niche or a particular profile of customer, whether it's geographically based or demographically based or however you want to slice that particular cake. So in that customer experience, they're going to find the data and the technology to meet that. They're going to need some flexibility in the middle to add and subtract as things change and protect the core at the same time. So I do think banks are particularly in a good spot as a data aggregator. As we described, we fear some of the other data aggregators because whether the standards are the same or not. And the question is, can we evolve fast enough to be relevant to our customers and put those technologies in place and access the data to do it? If you truly believe that banking is being digitized and you need to meet that. Are there questions, thoughts, comments relative to the data aggregators? Got a feeling we will hear this topic and the previous one again in terms of the way banking is going. Very good. Well, Will and Stephen, thank you very much for your presentation. And thank you to the council and everyone for that great discussion. If there's no more comments, this concludes the meeting of the CFPB's Community Bank Advisory Council. Thank you again for your time and have a wonderful rest of your day. Thank you.